Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Now, my visual quality may not be that great today, and my audio quality is sucking today. I got a lot of room. I could hear it in my voice, but I'm here nonetheless. I'm actually here from Orlando. I took a 24-hour trip to Orlando with my wife to see the Red Hot Chili Peppers concert last night, but I can't leave you guys hanging. If you're enjoying these videos, comment below these videos. Let me know your feedback. If you're watching on YouTube channel, post comments below this video. I respond to each and every one of them and read all of them. Now let's get into today's market. I'll make this a little quicker than usual since I'm not in my usual studio, but I think you'll get the pertinent data that you need out of this video. And again, I apologize for my appearance and the quality of this video. So the NASDAQ is down about 100 points, a little bit beyond random, and the Dow's down about 200 points, which is also beyond random. Put the call ratio is still grossly oversold and is coming down, so I'm expecting a reversal in the very, very near term. As far as sectors, I wanted to show you that this really is starting to look a lot like this. Matter of fact, look at Infotech, 21%, 16%. Materials, 18%, 14%. Real estate is already there. As a matter of fact, this may be a really good time to start looking at real estate. I'm going to be talking about that today in my VIP room when I'm there later today, and I will be there today. I'm going to be leaving in just a few minutes out of here as soon as I'm done with this video. So as you can see here, there is some vulnerability, like consumer staples. You have less stocks trading above the 50-day moving average than the 200-day moving average. That's telling us it's way overdone. The 200-day controls. And if you look at the broad market, let me just kind of show you this. If you look at the NASDAQ, you've got literally 19% of stocks trading above the 200-day moving average. On the NASDAQ 100, that is way, way overdone. Just to give you a perspective, look at where we're at right now. So we are bottoming out. Whether you like it or not, we are in fact bottoming out. Matter of fact, market went down yesterday. We had another down day. I mean, the VIX was up just barely. I mean, look, let me just show you on a daily chart what we're talking about. So volatility is not responding very much to this right now. And I don't think it's broken. I think it's just assimilating all of this value. And also, if you look at the bond market, you will see that it's not exactly dropping off. It's kind of sitting right here in that area. And as long as the bonds can continue remaining here, and I actually think bonds are going to rally, I think the stocks are going to go up with them. Let's talk a little bit about global economy. And again, I'm expecting a reversal. Maybe in the next 3 to 4 days, but I think we're going to have a nice juicy reversal to the upside. So higher than expected U.S. inflation dashed hopes that the Federal Reserve might back off plans for more interest rate hikes. Honestly, folks, I don't know who had these thoughts, but as far as I'm concerned, they're going 2 more times 0.75. On Thursday, the government data that was yesterday showed unemployment claims last week declined in August while consumer sales rose. That gives ammunition for Federal Reserve officials who say the economy can't tolerate more rate hikes. And it can. I believe it can. The S&P sank Thursday after the Labor Department application benefits to a 4-month low. Typically, when you see stocks near those levels, they tend to bounce pretty hard. The benchmark is down 4.1% for the week. The biggest pullback in 2 years on Tuesday after government reported U.S. consumer prices rose 8.3% from a year earlier and 0.1 compared with July. And the reason that happened is because that gives further doubt that the inflationary pressure has in fact peaked. Because we were hoping it was going to be closer to 7.9 to 8, but it hasn't. The overall figure was down from June's 9.1 peak, but, and here's the but, and here's the big but. Core inflation, which strips out volatile food and energy prices, gives a clearer picture of the trend, and that's what the Fed looks at. Rose 0.6% over the previous months, up from July's 0.3 increase. And that is what's giving investors and traders a big headache. 2 of the Fed rate hikes this year have been 0.75, and I think that's triple the usual amount. And yes, they should have started earlier, but I think that's going to continue for the foreseeable future. Mr. Jerome, I'm not going to tell you the truth till I get reappointed. Powell said in August that rates would stay elevated for some time until U.S. central banks would have inflation under control. It's not there right now. I could promise you, we don't have inflation under control. Retail data sales, again, didn't give us any major catalysts yesterday. It said consumers are coping with inflation, but sales rose by an unexpectedly strong 0.3%, after falling 0.4% in July. Again, everything is very, 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 very mixed right now. I'm encouraged by the fact that the bond market is not falling off the cliff after that data, and it looks like it's starting to come up. I'm encouraged by the fact that the put-to-call ratio is still highly elevated and hasn't broken below 1, which means the market needs to cool off. Come up. Now, looking at the major indices, let me give you the major indices and then we'll move into sectors. Oh yeah, it's like that. Let me just kind of go through this with you. At least my internet reception is good. So you can see here we're breaking lower, but if you look at the RSI level, the divergence is really, really, really strong. I mean, look at this. So to me, it looks like the market is getting very, very, very close to bottoming out. I mean, very, very close to bottoming out. I wouldn't be surprised if you saw a little Friday rally today. Also, on the NASDAQ, if you look at the NASDAQ, which was just opening down almost 1% today, you're seeing exactly the same type of divergence. And whenever you see a level of divergence like that, it typically tells us that the downside is just way, way, way overdone. And we're seeing that right now. Now, if you look at the small caps, which I definitely want to bring up right now, you will notice something very interesting. Look at the small caps. Notice they haven't broken lower. That's really, really significant. Why? Because small caps are the most speculative stocks. And the fact that small caps haven't broken down is a very positive sign for the overall market. Take a look at communication services, which is, by the way, in the dumpsters in terms of momentum levels. Look at that. They're barely breaking, while, say, XLI, for example, industrial, just to give you an example, is breaking down. So if you look at the stock fetchers, you will see right now something interesting is happening. Utilities, energy, healthcare, and consumer discretionary. If consumer discretionary continues to stay here or go higher, that'll be a very, 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 and I'll say it again, very bullish sign for the stock market. So keep your eye on consumer discretionary. Why? Well, let me show you why. And this is what I've been talking about. Consumer discretionary so far has been doing a pretty good job of staying above this resistance level. If we can stay above this resistance level for a few more days, this will in fact become support. And if you have Russell leading, if you have speculative sectors like let me show you the graph here, which we're already at. Like if you have speculative sectors not going down anymore, if communication services bottoms out here, if consumer discretionary bottoms out here, that's going to be very, 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 very bullish for the overall market. So if you look at in the big scheme of things, things are not as ugly as they appear. The fact that consumer discretionary is holding on is a positive sign, and it's telling us that a lot of those consumer stocks are overdone. Now, I want to show you something else. If you look at real estate, You see that? See how close we are to the bottom? And look at communication services. See how close we are to the bottom? Look at these momentum levels. Hold on, you got to see these momentum levels. Look at the momentum levels on communication services, 15%, 35%. Look at real estate, 6%, 10%. That's really, really low, really, really low. So this may be, look at real estate, 0, 0, 6, 10, 6, 10. This may be a good time to start looking at a few real estate stocks. As far as the broad market, let's look at the 50-day moving average. Let's look at the short-term trend. I want to be as thorough as possible with you to make up for the fact that I'm out of town. I'm just messing around. Let's go here. Oops, wrong study. Yeah, it doesn't look like there's that much more to go to the downside. So again, I think markets are going to open lower and then start heading higher. It's Friday. Maybe we'll see another down day today, but honestly, I'm not seeing that much more downside. I think this may be a good time to start buying stocks that have been overdone, like way, way overdone the last few days. And by the way, I changed my cursor to fluorescent green on this computer so you guys wouldn't miss anything. If that helps you out, let me know too. Now, let me get into some important stuff before I let you go. I do think the market is going to bounce back. I think we've got to be really patient, but I think this may be a good time to start coming into some value plays. I'll talk about that later today in my VIP room. Now, I know it was a rough week for some traders, But before you check out for the weekend, Jeff Zananeri wants to share an urgent market briefing with you at 1 p.m. Eastern Time. Again, it's happening at 1 p.m. Eastern Time. During today's briefing, Jeff will show you, get this, his number one strategy to trade during these volatile times, why Wall Street keeps buying this one asset over and over and over, why if you're caught trading during the day, you could get smoked, and why he's doubling down on something he's betting on 99% of the time traders are missing. Folks, grab a pen, a piece of paper, and get all the details. What he's going to show you today is highly actionable. So save this link below and use it to enter the room before 1 p.m. Eastern Time today. The link is in the YouTube channel in the descriptor, and I'm positive, it's also below this video if you're watching on YouTube. I'll see you guys later. Have a great weekend, and I'll see you in my VIP room today at noon. Bye, guys. Sorry for the video quality, but I think you guys got enough to work with here. Bye, guys. I'll talk to you soon. Any questions, send me an email. support@marketgeeks.com. Bye.